Today, we're really jumping into an in-depth exploration of the U.S. stock market.
Hmm.
Our mission here is pretty clear. We want to give you a comprehensive, fact-based understanding.
Right.
Why investing in this whole financial landscape has been such a cornerstone for building wealth for, well, generations.
Yeah. And it's important to say up front, like you said,
Yeah.
this isn't financial advice, right?
No, definitely not.
Yeah,
It's
yeah.
purely educational.
Hmm.
It's a journey designed to arm you with the knowledge, the historical context,
Hmm.
so you can really grasp the market's mechanics and, frankly, its consistent performance over time.
Exactly. And we get it. A lot of people feel maybe a bit apprehensive about investing.
Sure, it can seem complex.
Yeah. Or maybe there's just not enough clear information out there or too much noise.
Right.
So our analysis today, it aims to cut through all that. We're
Right.
grounding this discussion firmly in, historical data and even some very recent market events.
Good one.
We really want to empower you, the listener, to critically look at the information we present and hopefully see the underlying patterns that drive those long-term market trends.
Okay, so let's dive into the fundamental appeal, right? The stock market's really remarkable ability to generate significant returns.
That's the core of it for many
Yeah.
people.
Yeah, and our research into historical market performance, it tells a really compelling story.
Hmm.
Take the S&P 500. It's a key benchmark, right? Covers 500 of the biggest U.S. companies.
The big ones, yeah.
Historically, it's delivered really robust average annual returns. We're typically talking somewhere between, say, 8% and 12%.
And that's before you factor in inflation.
Crucial point. And look, these aren't just abstract percentages. They represent a powerful engine for actual wealth creation.
It's tangible.
Totally.
Mm.
To really get the long-term impact, think about this scenario. It's hypothetical, but it illustrates the point well.
Okay.
Imagine you invested $10,000 50 years ago.
Mm.
Just left it there, reinvested the returns. If that grew at just a conservative 8% annualized rate, which is, like we said, kind of on the lower end of the historical range.
Still solid return, though.
Oh yeah, that initial 10 grand, it would have ballooned to nearly $460,000 today,
Wow. That's significant.
isn't it? And that's not just theory. It's a real testament to the wealth-generating power the market has consistently shown through recessions, booms, busts. Decades of history back this up.
It really underlines the power of compounding over long stretches of time.
Exactly.
And what becomes particularly striking when we dig into these numbers is just how dramatically these potential returns outpace other, more common investment options.
Like bonds or just cash.
Precisely. Our analysis gives a pretty stark comparison. The average stock market return. It's been over 10% annually since way back in 1926.
Just before the Great Depression.
Yeah, think about everything that's happened since then. Wars, recessions, tech booms, high inflation,
Right.
and yet that upward trend persisted. Now, compare that 10% plus long-term government bonds, often seen as the safer bet. Just over 5% annually during that same long period.
Okay, half as much, roughly.
Roughly. And simply holding cash, maybe in a savings account,
Yeah.
slightly more than 3% annually. And again, that's before inflation bites into it.
So cash actually lost value in real terms, most likely?
Very likely over long periods. So this comparison, it really lights up the main appeal of stocks. Their historical track record for generating substantial wealth is, well, unmatched by these other common asset classes.
It makes them pretty much indispensable for long-term goals, doesn't it?
Absolutely. It's about harnessing the growth of the economy itself, not just incremental gains.
Okay, so that's the growth side. But this brings us to another really compelling point, one that maybe doesn't get enough attention.
What's that?
Stocks aren't just about building new wealth. They're also a really powerful shield against, well, a silent threat to the savings you already have.
You're talking about inflation.
Exactly. Inflation. Our research consistently shows stock market returns often significantly beat the rate of inflation. They act like a built-in defense for your money's buying power.
It's a crucial hedge.
It really is. Let's get specific with the history here.
Yeah.
The long-term inflation rate in the U.S., going back over a century to 1913, it averages around 3.1% per year.
Okay, about 3%.
Now, put that next to the double-digit average annual returns we just talked about for stocks.
Big difference.
Huge difference. The contrast is undeniable. It clearly shows how effective stocks have been as a hedge. They allow your purchasing power not just to stay level, but actually to grow. instead of slowly getting eaten away over time like it would if you just held cash.
Right. It ensures your money's working for you, not just sitting there losing value.
Exactly. Working as hard as you did to earn it.
And this naturally leads to a really important question for anyone thinking about their financial future.
Which is,
What's the real cost of keeping your money idle when inflation is always chipping away?
yeah, that safety of cash.
Right. Holding assets entirely in cash, it feels safe, it feels accessible.
Hmm.
But our analysis suggests it carries its own pretty significant risks, especially for your long-term growth potential.
Because of inflation eroding the value.
Exactly. That $100 today buys less next year and even less the year after. If your money isn't growing faster than inflation, you're effectively experiencing a slow, steady loss of real wealth.
So investing becomes crucial.
Investing in a diversified portfolio, yes. It allows your wealth the potential to grow, giving you more flexibility to handle changing economic conditions. Things like rising interest rates, changes in tax laws, whatever life throws at you.
It's like proactive financial defense.
That's a good way to put it. Not just passive saving, but active defense and growth.
Okay, so we've covered growth potential, inflation protection, but our research points to several other compelling advantages too. Stocks are actually incredibly versatile.
There's more to the story, absolutely.
Let's start with passive income. Lots of companies, especially the established profitable ones, pay out dividends.
Right, a share of their profits back to the owners.
Exactly. It's regular income paid directly to shareholders. Now, most pay quarterly, but our analysis shows some even pay monthly.
Which can be great for cash flow.
For sure. A valuable supplement to your income or a great boost for retirement funds. Just imagine getting regular cash flow simply for owning a piece of a company you like.
And many people reinvest those dividends automatically, right?
Yeah, DRAPs, dividend reinvestment plans. That just pours fuel on the compounding fire over the long term.
Okay, what else?
Then there's something a bit less tangible but still important. The pride of ownership.
Ah, owning a piece of the action.
Right. A share isn't just a ticker symbol. It's fractional ownership. You buy shares. You own a tiny bit of businesses whose products you might use every day.
Companies you admire or whose services you rely on.
Exactly. It creates this unique sense of involvement, connecting you to the economy in a way that's more than just financial. It's a link to innovation, to progress.
I can see that. It adds a different dimension.
Then let's talk practical advantages. Liquidity. This is a big one.
How easy is it to get your money back out?
Very easy, usually.
Yeah.
Most stocks trade publicly on major exchanges. You can buy or sell them relatively quickly on any trading day.
Compared to something like real estate.
Oh, totally different ballgame. Real estate can take months, sometimes years, to sell and turn into cash. Private equity might lock up your money for a decade.
Right.
Stocks offer way more flexibility. Accessing your capital when you need it is a huge advantage if life throws a curveball or a new opportunity pops up.
Good point. Flexibility is key.
And finally, the ease of diversification. This is really powerful.
Spreading your bets, essentially.
Exactly. You can easily build a portfolio diversified across tons of different industries. Technology, healthcare, energy, financials, consumer goods, you name it.
Reduces the risk of having all your eggs in one basket.
For sure. But our analysis shows diversification goes beyond just industries. You can diversify by company size, large cap, mid cap, small cap, by investment style growth versus value, even geographically owning international stock.
Giving you exposure to global growth, too.
Right? And often, you can achieve this broad diversification really easily through things like exchange-traded funds, ETFs.
So one purchase gives you a piece of many different things.
Precisely. And this diversification principle extends to your whole portfolio, mixing stocks with bonds, maybe even some alternatives. The goal is to smooth out the ride, reduce overall risk, while still aiming for good returns.
So if you pull all those features together, passive income potential, ownership benefits, liquidity, easy diversification, it really makes the stock market a uniquely powerful and adaptable tool for investors, doesn't it?
It really does. It's not just one thing. It's this whole suite of benefits working together. And look, for anyone listening who's thinking, okay, this sounds good, but I don't have thousands to start investing.
That's a common concern, the barrier to entry.
Right. But our analysis shows that barrier has crumbled. It's way less of an issue than it used to be.
How so?
Well, the modern ease of entry is pretty revolutionary. You've got $0 commissions from many brokers now.
Right, no trading fees.
And the widespread availability of fractional shares. This is huge.
Meaning you can buy just a small piece of an expensive share?
Exactly. You don't need $1,000 to buy one share of a high-priced stock. You can buy, say, $20 worth, or even less sometimes.
Wow, okay.
So investors can literally start purchasing stocks with less than $100, maybe even just a few bucks.
That really changes things.
It totally does. It's dramatically lowered the barrier, truly democratizing wealth building. Stock ownership isn't just for the big institutions anymore. It's accessible to almost everyone.
Okay, so building on that accessibility, this leads us to a question that's always on people's minds,
Oh,
right?
yes. Is now the right time to invest?
Bingo! That question. It pops up constantly, especially when markets feel uncertain or volatile.
And it can paralyze people,
Yeah.
right? They wait for the perfect moment that never seems to arrive.
Exactly. But here's the thing. Our analysis points to something kind of counterintuitive.
Okay.
There really isn't an inherently wrong time to start investing in the market.
So trying to pick the perfect bottom is
Yeah.
maybe not the best strategy.
It seems not. What our research shows is far more crucial is simply getting invested. And maybe even more important than that.
Staying invested.
Staying invested. Consistency over the long haul. That seems to be the key.
Okay. Illustrate that for us.
Sure. Think about this hypothetical but really powerful scenario. Imagine someone, let's call them the unluckiest investor ever.
Okay.
This person invests, say, $5,000 every single year, but they have the absolute worst timing imaginable. They always invest it right at the market peak for that year, literally the most expensive day.
Wow. Okay. That's truly terrible timing.
Consistently awful. But here's what our deep dive into historical data shows. Even that strategy, investing at the peak every single year for decades,
Yeah.
still significantly outperformed just holding cash over the same period.
Get out, even with the worst possible timing.
Even then, it's a really powerful testament to the market's underlying long-term upward bias. And the incredible power of just being consistent, even if your timing isn't perfect, or in this case, perfectly terrible.
That's fascinating.
What's really interesting here is how consistently trying to time the market has proven to be, well, largely ineffective.
It's just too hard to predict.
It's practically impossible, even for sophisticated professionals with all the data in the world, perfectly predicting the peaks and valleys consistently. It just doesn't happen reliably. Our analytical insight, looking back at decades of data, overwhelmingly shows that people who try to jump in and out of the market,
Trying to catch the swings.
yeah, they often end up significantly behind investors who just commit to putting their money in regularly, consistently, regardless of what the market's doing day to day or month to month.
So like dollar cost averaging.
Exactly. That principle strongly supports a dollar cost averaging approach. You invest a fixed amount, say $100 every month.
Right.
Sometimes that $100 buys more shares when prices are low. Sometimes it buys fewer shares when prices are high.
It averages out your cost over time.
Precisely. It smooths out the impact of volatility. And crucially, it takes the emotion out of it. You're not trying to guess. You're letting time do the work.
Okay, so if trying to time the market is a pitfall, what about the opposite? What's the actual cost of not being invested? Just sitting on the sidelines.
The opportunity cost.
Yeah. Our research really drives home a critical point here, and it can be kind of painful to think about. Being out of the market, even for what seems like a short time, can seriously diminish your long-term growth potential.
You miss out.
You miss out big time. It's not just small gains, it's significant lost opportunity that really compounds over the years.
Got a specific example?
Yeah, here's a striking statistic from our analysis. Think about the period since 1988. A hypothetical investor who missed just the best 5 days in the market during that entire time.
Just 5 days out of, what, over 35 years?
Exactly. Missing just those 5 best days could have slashed their long-term gains by an incredible 37%.
37%, just from missing 5 days.
Yeah. It's staggering, isn't it?
Yeah.
That's an immense impact on your final outcome. It really highlights the hidden but very real cost of trying to sit out volatility.
And that brings up a really important question for anyone thinking about waiting out a downturn.
Which is,
Are you really prepared for the risk of missing those crucial rebound days? Because what's often overlooked
people don't realize.
is that our data consistently shows these best days, these huge upswings, often happen immediately after the worst days.
Right after the big drops.
Exactly. They're often clustered together. This makes them incredibly difficult, almost impossible to predict and capture if you're trying to jump in and out.
So you might miss the crash, but you'll probably miss the rebound too.
That's the huge risk. You think you're being smart, avoiding the pain, but you end up missing the biggest gains. This fact just profoundly underscores why being consistently present in the market, long term is so important to capture that overall upward trend.
You got to be in it to win it, basically.
Pretty much. It's about being there for the whole journey, the ups and the downs, not just trying to cherry pick the good parts.
Okay, let's talk about another powerful aspect. The market's sheer resilience. Its ability to persevere and recover, even when facing major global shocks.
Yeah, this is fundamental. It reflects the underlying strength and adaptability of the economy, really.
Right. Historically, stock markets have shown incredible resilience. They tend to recover and often push higher, even during really tough times.
Wars, recessions, pandemics.
Exactly. Geopolitical crises, you name it. This inherent ability to persevere has consistently rewarded patient, long-term investors.
Are there patterns to this recovery?
Definitely. Our analysis shows some clear general patterns. For instance, on average, stocks have historically recovered all their losses roughly 11 months after a recession officially began.
Less than a year on average.
Yeah, and frequently, they go on to surpass their pre-recession highs relatively quickly after that.
We've seen that play out multiple times.
Absolutely. Think about the dot-com bust in 2000, the 2008 financial crisis, and more recently, the 2020 market shock.
The COVID crash.
Yeah. Remember that initial terrifying plunge through March 2020? Severe recession fears, global shutdown.
Oh, yeah. I felt like the world was ending for a bit there.
It did. But despite that extreme pullback, the market rallied incredibly strongly for the rest of the year. By the end of 2020, it was up almost 20%.
An amazing turnaround.
It really was. And it vividly illustrates the point. Even if you knew a massive crisis like COVID was coming, selling everything and sitting in cash would have meant missing that huge, rapid recovery.
The market looks forward, doesn't it?
It seems to. It has an incredible way of pricing in future recovery and growth, even amidst current turmoil.
And that resilience, it's not just a fluke. It's a fundamental pattern.
Right.
The market adapts, it processes new information quickly, and it keeps moving forward. This tendency to recover, often swiftly, and eventually hit new highs, that's foundational to the long-term case for stocks. It mirrors the growth and innovation of the underlying companies.
Okay, so the market's resilient to economic shocks. What about political ones? That's a common worry, especially around election time.
The political factor. Will Party X be better for my portfolio than Party Y?
Exactly. People worry specific policies will tank the market, or that one party being in power is inherently bad for investors.
Understandable concern, but what does the data say?
Well, our analysis of extensive historical data suggests something pretty interesting.
Which is?
The political party controlling Washington, the White House, Congress, it's typically had minimal effect on long-term stock returns.
Really? Minimal effect.
Surprisingly minimal, yeah. It's a remarkably consistent pattern across different political eras. The S&P 500, on average, has delivered positive returns under pretty much every partisan combination you can think of.
Unified government, divided government, doesn't seem to matter much in the long run.
The long-term trend seems much more influenced by underlying economic factors than by which party holds the reins.
And what's really critical here, I think, is separating the noise from the reality. Meaning the difference between campaign rhetoric and actual policy implementation.
What's promised versus what actually happens.
Exactly. Our analytical insight strongly advises against making investment decisions based purely on campaign promises.
Why is that?
Because there's often a huge gap between what's proposed on the campaign trail and what actually gets enacted into law.
Legislative hurdles, compromises, changing circumstances.
All of that. Our research shows it's incredibly rare for a candidate to deliver exactly what they promised. The complexities of governing are immense.
So betting on specific policy outcomes based on promises is risky.
Very risky. The takeaway is that broad market movements seem driven by more fundamental, enduring economic forces, things like corporate earnings, innovation, global demand, interest rates, rather than short-term political shifts or who happens to be in the Oval Office.
It's a bigger picture game.
It's a long game, a macro game, not primarily a political one, despite the headlines.
Okay, to really bring these ideas of market resilience and looking past short-term noise to life, let's examine a really recent, really compelling example from our analysis.
Right.
The market's reaction to those Trump tariffs that were implemented just earlier this year, 2025.
Still fresh in everyone's memory.
Absolutely.
Yeah.
This is ancient history. This is just a few months ago.
Yeah.
Let's break down what happened. First, the initial shock.
The crash.
Right. April 2nd and 3rd, 2025. These sweeping reciprocal tariffs ranging from 10% up to pretty hefty 50% were suddenly put into effect.
And the market reaction was?
Immediate and sharp.
Yeah.
U.S. stocks plunged. Both the S&P 500 and the Nasdaq dropped over 10% really quickly. Billions wiped off market values.
Wow, a correction territory very fast.
Instantly. And it wasn't just the U.S. Global markets tanked too. It showed how connected everything is and how much uncertainty this created.
A moment of real fear for investors, I imagine.
Definitely. Fears of a trade war,
Mm.
economic slowdown.
Mm.
It felt pretty grim for a few days there.
And that initial reaction, that sudden, significant drop, it really illustrates how sensitive the market is in the short term to big, unexpected policy changes or geopolitical events. It's a classic example of the market rapidly pricing in uncertainty and fear. The potential negative consequences get factored in almost instantly.
It's like a collective gut reaction, repricing risk on the fly.
Exactly, based on new, uncertain information.
But, and this is the crucial part, the really remarkable part of this story, the market's narrative didn't stop there. It didn't end with that plunge.
Okay, so what happened next?
Our analysis reveals an incredibly swift and powerful recovery. It's like Exhibit A for that underlying resilience we keep talking about.
How swift are we talking?
Just a few trading days later. By April 9th, the word came out that the additional tariffs were being paused, pending further review.
A bit of relief from the uncertainty.
Huge relief. And it triggered an absolutely massive rebound. The S&P 500, our key benchmark,
Yeah,
it soared roughly 9.5% in a single day.
9.5% in one day. That's enormous.
It's huge.
Yeah.
A gain we hadn't seen the likes of since way back in the 2008 financial crisis recovery.
Wow, an incredible turnaround.
And it didn't stop there. By early May, so about a month after the initial crash, the markets had completely wiped out all the losses from April.
Back to even already.
Back to even, but then they kept climbing. By June 27th, less than 3 months after that initial terror shock, the S&P 500 hit a new all-time record closing high.
A record high.
A record high.
Huh.
Roughly 27% above the low point it hit back in April.
So not just a recovery, but a powerful surge into new territory. Okay, connecting this back to the bigger picture. This incredibly rapid, robust recovery. It's just such a powerful, real-world confirmation of the market's underlying resilience, that long-term upward bias. This event, I mean, despite how sharp and scary the initial drop was, it just demonstrated the market's ability to quickly process new information, adapt, and recover, especially once the immediate uncertainty eases up.
Like when the tariffs were paused.
Exactly, and really hammers home the potential danger of panic selling, right?
Yes.
Reacting impulsively to those short-term shocks.
Because you'd lock in losses and miss the rebound.
Precisely. Anyone who sold in fear during that April dip would have locked in big losses and completely missed that extraordinary rebound to new highs. It's a perfect recent example of why time in the market usually beats timing the market.
Okay, and who was doing the buying during this rebound? Was it just the big institutions?
That's a great question. And our research uncovered something really interesting here. During that critical recovery period, retail investors, individual investors, everyday people played a huge role.
Really? How much?
They poured a record $155 billion into U.S. stocks and ETFs during that time.
$155 billion?
Yeah.
From retail? That's massive.
It's a record influx. It showed tremendous collective confidence from Main Street in the market's ability to bounce back.
And did that buying actually move the needle?
Oh, absolutely. Our analysis indicates the substantial flow of capital from individuals significantly contributed to the rapid recovery. It helped push the tech-heavy NASDAQ 100 up by about 31% from its lows, and the broader S&P 500 up around 7.8% since that tariff dip.
So it wasn't just Wall Street. Main Street played a big part.
A very significant part. The collective action of millions of individuals recognizing what they saw as an opportunity and acting on it.
The buy-the-dip mentality in action.
Exactly. What's fascinating here is seeing how collective individual action can significantly influence broader market movements, especially in those moments of perceived opportunity after a sharp sell-off. It shows retail investors seeing those downturns not just as crises, but as chances to buy assets potentially on sale before the recovery.
And their combined buying power helped accelerate that recovery.
It certainly appears to have contributed significantly to accelerating the recovery and pushing towards those new highs. It really demonstrates the power of investor confidence and consistent engagement, even when the initial headlines are scary.
When enough people believe in the recovery and act on it.
It can become a powerful, self-reinforcing force. Absolutely.
Okay, so we've spent a good chunk of time highlighting the really compelling benefits, right? Growth, inflation protection, accessibility, the market's resilience,
The upside.
the upside. But, any responsible, thorough discussion has to look at the other side too.
Absolutely. The risks,
Yeah.
potential downside.
Exactly. And also maybe acknowledging that investing in stocks isn't necessarily the right move for everyone in every situation.
Crucial point. It needs to fit your circumstances.
Right, so let's start with something that might sound a bit backward at first.
Hmm.
The risk of not investing, the risk of just keeping everything in cash.
The perceived safety of cash.
Yeah. Holding all your money in a Favies account,
Yeah.
it feels really secure, doesn't it? Tangible safety, immediate access.
It does provide that feeling, yes.
But our analysis clearly shows that strategy carries its own significant risks, especially when you think long-term.
How so?
Well, simply put, the potential growth, the wealth appreciation you could achieve in the stock or bond markets over time. You just won't get that sitting on the sidelines in cash.
You're actively choosing to forego that potential growth.
Exactly. You're sacrificing the opportunity for your money to really work for you and compound over time.
And this brings up that critical question again. What exactly are you giving up for that feeling of safety?
Right.
We talked about inflation earlier, but it's worth hammering home. That constant, quiet erosion of purchasing power,
It just eats away at your savings.
relentlessly. So the safety of cash often turns out to be an illusion, especially when you're looking at long-term goals, funding retirement, paying for college, big future purchases.
Yeah.
Holding cash means you miss out on that potential capital appreciation. You miss out on potential dividends. Your money might be safe from market drops, yes, but it's definitely not safe from inflation's silent tax.
And over decades, that silent tax can be way more damaging than a few market bumps.
Often, yes. Far more damaging over the truly long term.
Okay, so that's the risk of cash. Now let's talk about the risks within the market itself. The volatility. The bumps.
The roller coaster ride, as some call it.
Yeah. Let's be clear. The stock market is inherently volatile. Prices can, and definitely do, swing significantly, sometimes wildly, especially in the short term.
It's not a smooth, straight line up.
Not at all. Our research shows, on average, the S&P 500 ends the year down roughly 3 out of every 10 years.
So negative years happen regularly.
They do. And some of those drops, frankly, can feel pretty brutal when you're living through them. It's emotionally challenging for investors.
Understandably so.
And we can get even more specific with expected downturns based on history.
Okay.
On average, the market experiences a decline of at least 10% from its highs. That's a correction about once every 11 months.
So expect a 10% drop almost yearly on average.
Roughly, yeah. A bigger drop, 20% or more, what we call a bear market, happens on average about every 4 years.
Okay.
And historically, the market sees a decline of more than 30% at least once per decade.
Those are the really tough ones.
Yeah. But the key point here is these aren't freak events. They're a normal, cyclical, expected part of how the market behaves over time, driven by economic cycles, sentiment shifts, global events.
And what's really vital here is to internalize that. These declines, these corrections and bear markets, they aren't anomalies. They are part of the process.
Right. Not bugs, but features, almost.
In a way, yes. While these stats highlight the unpredictable short-term moves, they're also intertwined with the long-term growth story. Corrections often shake out excesses, reset valuations. They can be healthy, paradoxically.
Okay.
But, and this is huge, but it's absolutely crucial to recognize this level of volatility isn't for everyone.
Who should be particularly cautious?
Well, anyone with a genuinely low risk tolerance. If the thought of seeing your portfolio drop 10%, 20%, or more causes you extreme anxiety and sleepless nights.
The emotional toll might be too high.
Exactly. The potential gains might not be worth the stress. Also, anyone who knows they will need that specific capital in the near future, usually defined as the next 3 to 5 years.
For a down payment or tuition.
Right. For those folks, putting money needed soon into volatile stocks is very risky. You might be forced to sell when the market's down, locking in a loss in principal just when you need the funds.
That risk of short-term loss is real.
It's absolutely real. Understanding and accepting that is fundamental before you invest in stocks.
Okay, so given that volatility, given the potential for those short-term drops, when specifically might investing directly in stocks not be the best move for someone?
Our analysis points to some clear scenarios where you should definitely pause and think, maybe prioritize other things first.
Like what?
Well, first, as we just touched on, if you truly can't stomach a significant decline. If a 10% or 20% drop would cause you overwhelming emotional stress.
Leading to panic selling, maybe?
Potentially, yes. And making investment decisions based on fear during downturns is almost always a losing strategy. So if that's you, stocks might not be the right fit, or at least not a large part of your portfolio.
Yeah.
Second, that short time horizon. If you know with certainty you need the money within, say, 3 to 5 years for a specific, large planned purchase house down payment, upcoming college bills, starting a business,
Don't put that money in stocks.
it's generally ill-advised. The risk of needing it when the market is down is just too high for funds earmarked for specific short-term goals.
Makes sense. What about retirees?
Third, yes. If you're already retired or very close to it and your primary need has shifted, you're not focused on growing capital anymore, but on preserving it and generating a steady, reliable income stream to live on.
Income versus growth.
Exactly. While some stocks pay dividends, the overall volatility of stocks might not suit a portfolio that needs to prioritize capital preservation and predictable cash flow above all else. Bonds or other income-focused investments might be more appropriate.
Got it. Are there other financial priorities people should tackle first?
Definitely. Our research highlights a couple of big ones. High-interest debt is key.
Credit cards, personal loans.
Yeah. If you're carrying substantial debt with high interest rates, paying that off aggressively often gives you a guaranteed high return. The return is the interest you're not paying anymore.
A guaranteed return versus an uncertain market return.
Exactly. Often, tackling high-interest debt is mathematically the smarter move before investing significantly in the market. Think of it as earning, say, 18% risk-free by paying off that credit card.
Good point. Anything else?
Lack of an emergency fund. This is critical.
The rainy day fund.
Right. Typically, 3 to 6 months worth of essential living expenses kept in a safe, easily accessible place like a high-yield savings account.
Why is that so important before investing?
Because if you don't have that cushion and an unexpected expense pops up, job loss, medical bill, car repair, what happens?
You might be forced to sell your investments to cover it.
Exactly. And you might be forced to sell them at the worst possible time during a market downturn, again locking in losses. The emergency fund protects your long-term investments from short-term life events.
So debt reduction and emergency fund are foundational.
Absolutely. And one more thing, be realistic about your time and interest. If you genuinely don't have the time or frankly the desire to research individual companies,
Then maybe picking individual stocks isn't for you.
probably not. In that case, passive strategies like broad market index funds or ETFs or even seeking professional financial advice might be a much more suitable and less stressful path. Know thyself, basically.
That's good advice.
And all this really leads back to a fundamental question, doesn't it?
Which is?
Have you truly laid your personal financial groundwork before you start taking on market risks?
Getting your house in order first.
Precisely. Our analytical insight just stresses the absolute importance of building that solid foundation. Manage or eliminate high-interest debt, build that robust emergency fund.
Yeah.
Only then, once those pieces are solidly in place, should you really focus on aligning your investment choices with your unique personal financial goals, your specific time horizon, and, critically, your individual tolerance for risk.
It's about finding the right mix.
Exactly. Our analysis consistently shows investors tend to find more comfort and ultimately more long-term success with a strategic, balanced mix of different asset classes, stocks, bonds, maybe some short-term investments tailored specifically to their situation, not a one-size-fits-all approach.
It's a personalized journey.
Absolutely.
Okay, so pulling all these different threads together now. The benefits, the risks, the resilience, the pitfalls. The overwhelming message that really comes through from our analysis seems crystal clear.
And what would you say that is?
When it comes to successful long-term investing, consistency and just being present are king.
Playing the market.
Exactly. Our research emphatically shows that what's far, far more important than trying to perfectly time the market is simply having your time in the market.
Waiting for that perfect moment.
Yeah, waiting for the perfect moment to buy, waiting for the dip, waiting for the stars to align. It can be incredibly costly.
Quite costly.
Primarily because, as we touched on, a huge chunk of the market's total gains over the long run often comes from just a very small number of incredibly strong days.
Those best days we talked about.
Right. If you're sitting on the sidelines trying to time your entry, you risk missing those crucial, unpredictable upswings.
Yeah.
And missing just a few can severely damage your long-term returns.
Let's look at the odds, maybe.
Good idea. Here's some compelling probabilistic evidence from our data. going way back to 1928.
Okay.
Over any single year in U.S. stocks, there's been almost a 3 out of 4 chance of getting a positive return.
75% chance of making money in any given year, roughly.
Roughly, yeah.
Yeah.
But here's the kicker. Those odds get even better the longer you stay invested. The longer your time horizon, the higher the probability of a positive outcome.
Makes sense. What about holding cash?
Conversely, holding only cash.
Oh.
Well, you might face only about a 1 in 4 chance of a positive real return after inflation over a single year. And over a longer period, say 15 years, that chance plummets to maybe only 2%.
Wow. So the odds strongly favor being invested long-term.
Overwhelmingly so. The data strongly supports consistent long-term market participation over trying to dance in and out based on short-term guesses.
And this ties back to market corrections too, right?
Absolutely. As we discussed, our analysis shows stocks historically tend to recover from those corrections, drops of 10% or more often in a matter of months, not years.
So volatility happens, but recovery tends to follow.
That's the historical pattern. The evidence is really robust. The longer you remain consistently invested, the lower your probability of actually losing money becomes, especially when you look at periods of 5, 10, 15 years or more.
It demonstrates that powerful long-term upward trend, despite all the short-term noise and bumps along the way.
Exactly. It's about riding out those inevitable storms to ultimately benefit from the prevailing tailwinds of economic growth and corporate innovation.
Okay, so if being in the market long-term is key, does it matter what you're invested in during that time? Or can you just buy anything?
Great question. Quality matters. Our analysis really aligns with the wisdom of experienced investors like David Gardner from The Motley Fool.
What did he say?
He famously said something like, "It doesn't matter when you invest if you are investing in great companies."
Interesting emphasis. Focus on the quality of the business.
Exactly. It highlights a crucial point. Over the long run, a relatively small number of truly exceptional companies actually drive the majority of the market's overall returns.
The big winners pull the average way up?
Precisely. So this underscores the value of being selective, focusing on quality investments, even if you're a long-term investor. It's not just about being in the market, but about being in the right parts of the market.
Businesses with sustainable growth, strong management, competitive advantages.
All those fundamentals. And this principle also reinforces the value of smart diversification.
Don't put all your faith in just one or two great companies either.
Right. You want to choose wisely, but also spread your risk intelligently. Which brings us back to finding the right overall strategy for you.
The personalized approach again.
Yeah. Our research ultimately suggests the most effective path involves finding a balanced asset allocation, that mix of stocks, bonds, cash, that is specifically tailored to your individual situation.
Considering those key factors.
Right. Meticulously considering your time horizon. When do you need the money? Your personal risk tolerance, how much volatility can you truly handle, and your specific financial goals. What are you actually saving and investing for?
It all has to work together.
Exactly. Our analysis shows people generally find more comfort and achieve better long-term success when they have that strategic mix tailored to them, rather than chasing the latest hot stock or following a generic formula.
So ultimately, this whole journey, this process, it's really about aligning your investment strategy with your own unique financial dreams, your goals, and importantly, your personal comfort level with the ups and downs.
Yeah, deeply personal. No single right answer for everyone.
Absolutely. And perhaps the fundamental takeaway from all our analysis, from looking at history, resilience, risk, is that for most people who have laid that financial groundwork we talked about,
Yeah.
the optimal time to consider buying shares of a great company or investing in a well-diversified market fund is almost always right now.
Not trying to wait for the perfect signal.
Not trying to wait. Aligning the decision with your personal financial readiness and long-term goals rather than trying to second-guess where the market might go next week or next month. Because as our data suggests, waiting, procrastinating, that's often the most expensive choice of all.
Okay, let's try and wrap this up. A concise recap of the key takeaways from this educational deep dive.
Let's do it.
We've explored the really compelling, historically proven benefits of investing in U.S. stocks, that powerful long-term growth potential, the crucial protection against inflation. We saw the market's remarkable resilience highlighted by that recent 2025 tariff episode, that swift recovery to new highs.
A powerful example.
We hammered home the critical difference between the value of time in the market versus the often futile and costly attempts at timing the market.
Consistency over prediction.
Exactly. And we stress the importance of understanding your own personal risk tolerance and getting your financial house in order before diving into significant market investments.
Know yourself, know your goals.
Right. So the final thought, the question maybe for you, the listener, is this. Armed with these insights, understanding the immense power of long-term consistency, what steps will you take, maybe starting today, to secure your financial tomorrow?
That's the key question. And remember, knowledge is most valuable when it's not just, heard or absorbed, but when it's truly understood and then consciously applied.
Right.
We really hope that what we've shared today serves as a solid foundation for your ongoing financial journey. We hope it empowers you to make informed, confident decisions that are right for you.
Well said. And if you found this discussion insightful, if you want to keep building that financial knowledge with more in-depth analysis, more surprising facts,
Then what should they do?
we definitely encourage you to subscribe to the Deep Dive. By subscribing, you'll get access to more investing talks like this, more detailed analyses, all designed to help you become even more well-informed and confident in your financial understanding.
So join us as we continue to unpack complex topics, cut through the noise, and hopefully bring you the clarity you need to navigate the world around you.
Thank you so much for joining us for this educational deep dive into the U.S. stock market. We really look forward to our next exploration with you.